Hello, ladies and gentlemen. And the week finished very weak. Minus 28, the final score on Friday. So what we are having now is basically a double dip in the moving averages. The price is moving below all the moving averages and will probably get worse over the next few days. As you can see, we tried to go positive a couple of times last week, barely made it, and then on Friday, with a weakness in the market, the model score went all the way down to minus 28. The by far the worst. The weekly one, minus 22 last Friday, minus 28 this Friday. We are getting the same type of picture as in the daily on the weeklies, which makes it more likely than not that we will get a double dip here in the price. What is important always is to have a look at the deviations, and that is why they're here. If we enlarge it and have a look at the whole thing, we'll see that we are now in a flat period with the 2 standard deviation up at 28.80 roughly in terms of futures, but we know that 28.64 has proven itself. It is by far the most important level of the year. 28.64 will continue to be a very important level. What is the market likely to do? Well, we will look at the sectors in a moment, but we can see that we have this rising moving average here now in the standard deviations, which will be around in the next couple of weeks. It'll be around 28.20, 28.30, 27.20, 27.30, and that is going to be a very important level. We will look later on to have a look at what the really important levels are. But here we are, XLE. XLE pretty well supported, another 0.5% to 1% lower. We have a look at the next. The telecoms probably have some more room to the downside. But the one that is quite impressive is XLU. XLU basically is tracking bonds, and that is saying that we have quite a bit of room before we reach the red area. And it's incredibly overbought. We're making new highs. XLU certainly a driver to the upside. And here we have XLB materials are going to be pretty well supported very soon. And if we have a look at the telecoms, those the XLK, the technology, this one made it on Thursday to the red zone and straight back down. Now this one has quite a bit of weakness backing and filling that it can do, and it can be one of the drivers for SPY to come lower. If we have a look at XLF, you will see that very soon, and this level here is going to be very important, around 25 is going to be very, very strong support. That to me indicates that XLF pretty soon is going to get supported, and that is going to support in turn SPY. We will look in a few moments to see where the real supports in SPY are, but this tells me that we are absolutely not going to have a meltdown in SPY over the course of the next couple of weeks. We will go and trade some support levels, and we will identify those in a moment. If we have a look at XLV, we will see that now it's on support. XLV, probably it's a better time to buy than to sell. XLP probably has a little bit of room on the downside, but not very much. XLP is not one of the ones that should be having trouble at the moment. But XLY, we see that if we touched the, just like XLK, we touched into the red and straight back down. That can probably come down another 2-3 percentage points and give us support at the at this moving average. XLI, we should get some better support. These are all formations which do not argue for a complete breakdown in SPY, but basically that this is a time of backing and filling. XLC, nothing much to see here. The real estate sector is doing okay. It doesn't have very much on the upside. It's more likely to come down than go up. And basically all this is saying consolidation over the course of the next couple of weeks. I continue to believe that this is one of the most important charts to keep on looking at all day, every day. And this is the minus 245 basis points difference between 10-year Germany and 10-year US. As you can see, we keep on bouncing off it, We can't break through. If we were to break through on a weekly basis, or even on a closing weekly basis, that should put pressure on the dollar. But at the moment, as it is, it's not putting pressure on the dollar. It's still in this 10-15 basis point trading channel, which is ever so narrow. At some stage, it will decide which the next move is, and that is when we will jump all over the dollar. At the moment, that is not it. We're not seeing it. Therefore, we're doing absolutely nothing in the dollar. If we analyze the components of that spread, we will see the bonds touched negative territory. We're looking for minus 0.2 basis points, and that is exactly what we got last week. We no longer have a position in bonds. It is likely now, over the course of the next several days and weeks, to actually trade minus 15 or minus 16 basis points. That is going to be the very important swing level. We showed you that if it broke 7.5 to 8 basis points, it was likely to go to minus 0.2. And now, if it can stay around this level, at some stage it's likely to go and trade minus 15, minus 16 basis points. Ridiculous, but this is the market. This is what the central banks have reduced us to. Negative rates in 10-year notes in Germany. This is a yield chart of the 10-year note in the States. You can see how far through the Bollinger Bands we are. We are very, very oversold here. But the momentum is very strong. Maybe 2 or 3 to 4 days of backing and filling, why not? Would make sense. And then at some stage, my objectives are here, 233 and basically 229. So let's call it 230, 231 in terms of yields, where this market should stop and have a reaction higher. But this is telling you a story, isn't it? You can see how basically we are doing one of these phases probably. A few days sideways and then back down. Few days sideways, fill this gap and back down to this area, which is going to be key and pivotal around 231, 232. This is probably going to coincide hitting these levels when bonds are trading around minus 15. I continue to think that the yield curve steepens in terms of the overall shape against 30s. The belly of the curve, the 5s are doing the best, and they will continue to do the best. We are looking for them to trade just below 2%. So another 25 basis points in the 5-year note is probably not something that is too much to ask of the 5-year note. 2s and 5s to me are still the best place to be invested in the bond market. On a weekly basis, SPX has done basically everything we thought it would do. It's backed off the 2864. It closed right at its lows. It would make sense now for a couple of weeks of trading somewhere very close to this moving average in blue and this one in red. If we enlarge them, you can see that they are rising, and therefore they will be slightly higher next week. But we're talking about 27.55, maybe 27.35. So that should be the absolute bottom, unless we're going to go much lower. I think if we manage to break this 27.35 level, we unfortunately are in a world of hurt, because we are definitely going back down to 26.77, which was that very important pivotal level where the Fed managed to force through, using Powell's speech, force the market through 2677, opening up the upside. I don't think the market is going to have or has cause to see prices that much lower than these moving averages. So 27.50-60 is really where you want to start buying some pretty decent call spreads. Couple of weeks of trading sideways, and that could actually give us enough momentum to go and break that 28.64 level. Certainly 28.64 has proven its worth, and any close above it will indicate a very imminent break of many percentage points higher. From a monthly chart point of view, that 27.50-60 level becomes very, very important indeed too. We have this line 27.30 odd. That is really as low as the market can possibly go. If in March we close below 27.30, we have a big problem on our hands, but I don't think we will. I think we will close much, so maybe a little bit lower than we closed on Friday, but not that much lower. Certainly 27.50, 60, 70 are the areas to start buying in terms of S&Ps. And even the daily chart basically backs it up. The first important support is going to be around 27.86-88 already on Monday, and then we have these moving averages right here, which are pretty flat. We have the 200-day at 27.55, we have the Bollinger Bands underneath at 27.46, and then finally we have the 100-day moving back up, which is 27.34. So everything is going to be bunched up in the dailies, in the weeklies, and in the monthlies between, say, 27.60 and 27.40. We close below there in terms of the week, the month. We are going to be in a world of hurt, but I see absolutely no reason why that should happen at the moment. Neither the transports nor the Dow indicate that we are in for a big fall in the market. The transports are here supported by the lower Bollinger Band. It closed right on top of the lower Bollinger Band. It might work its way a little bit lower, but not very much. And the same thing is really happening in terms of Dow. On this side, we have the lower Bollinger Band coming at around the 25,400 level, and then we have the 100-day and the 200-day, and this is going to be a very important level here around the 25,200. I really don't think the market breaks 25,200 in a hurry. And it's going to be supported from all sides. I think that's going to be a wonderful risk-reward area to buy. Just above 25,200, it should slingshot from there at least to 25,800. If we look at what the volatility is against the market, that's saying basically if we come and fill one of these little gaps here, which I can show you, we're looking at this gap here, which is down at 27.83, which is less than 1% from where we closed on Friday. We will already be in the top of the volatility Bollinger Band here, where the 200-day moving averages were around the 33.60 area in VXXB. And that will be a great short in volatility and a great long here in terms of S&Ps. So again, I really don't see very much downside in S&Ps over the course of the next couple of weeks. Nice backing and filling between, I don't know, 28.30, 28.40 and 27.60 would be ideal for the next few days. To build some kind of an area where we can again go and challenge the 28.64 area. The one market which is definitely looking less bullish than the States is Europe. And this is DAX. It achieved the 11,800 level that we've been parroting on about. We bought some put spreads, and now it really has the chance to come down to 11,163. This very, very important level. Would not be surprised to see it next week. But it also confirms that it is a much weaker pattern than in the States. The States are far more impulsive than Europe, and it looks like Europe is potentially in for a longer period of underperformance now than the United States. In the dollar index, same old story, same old, same old. It keeps on going back to 96.50. It keeps on being very neutral. On the other hand, it keeps on staying above the 200-day moving average. Maybe at some stage, as we showed you, the market will break one way or the other in terms of spread differentials, and then the dollar will make its move. But while it does that, it's just going sideways. It's just trading between the pivot points, 96.50, 97.54, and basically here 95.07. While it does that, the best position to have is one of short volatility. But volatility now is so low in the dollar products, in the foreign exchange products, that I really would not countenance a short volatility position here. We have our levels, we have our causes of the dollar movement, and we have to be patient and wait for them to happen. So what are our biases? Basically, just about everything we said last week has more or less happened. We were looking for the 255 level in 10 years to buy straddles. We got it. Now we're staying long with those straddles, and I'll tell you, the market basically should go around to the 230. That is the level where one has to take profit and say thank you very much indeed. It might take a good week to get there, but or even 2 weeks to get there after a bit of seesawing up and down, but we'd be happy to see it there. The bunds, we got to the minus 0.2, and now what we're saying, at some stage it'll go to minus 0.16. Forgot the minus sign in front of it. It's so unusual to actually have a minus sign. So we'll go to minus 16 basis points is our next objective. That is what we're looking for. The XPX, we basically said 28.64 is the level. It is. Now 28.12 is not so much a level on the downside, it is this to the upside, although it is a level. But really what we want to see is basically 27.80 to 50 area. That is where the buying should, the bulk of the buying should take place, in that 1% range, so we can make a base for a new high. Volatility is still trapped. I didn't show you the downside, but the downside is still 1150. It's not going to happen next week, but the upside is very much capped. So I don't expect much more than you know, that kind of 20, 30, 40 point drop in the S&Ps next week. The European equities, it got to 11,800 in the DAX. We bought them some put spreads. It's beginning to be quite binary. Either it's going to underperform a lot the S&Ps, and the S&Ps basically stay sideways for 2 or 3 weeks, and the DAX drops another 2-3%. So that spread between the States and Europe goes out another couple of percentage points, and then the DAX can follow upwards the trajectory of the S&Ps. If the S&Ps then base and take out 28.64, the DAX will naturally go up with it, but probably only just as much as the S&Ps, if not slightly less. So that is how Europe underperforms overall. We've said all there is to say about the dollar. I know that some people say that you get the dollar right and you get everything else right. Well, at the moment, I would say you get bond yields right, you get everything else right. The dollar is in a sideways range. I will only get very bearish of it if it starts breaking 93.63, and I will only get very bullish of it if there is a if we break that differential chart that I showed you between 10-year Germany and 10-year US. I don't think the dollar can go much higher without that chart showing you the way. Thank you very much indeed, and I tweet you on Monday.